Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index is the one that's managing to hold on to strong gains of 0.8%.
The stock in yesterday's trading session actually was quite strong, and it's continuing to defend this 20 DMA.
Because both the sides are looking to sign that the first tranche by September or October of this year.
We have a 42-point gain, 50, now 60-point gain on the index.
I think we look at the entire universe, internal and external, and choose the right candidate for the bank.
Listed at 13% premium yesterday, and even today the stock is up more than 5%.
Today there's some green, and I chose the right color today. So Nifty is up around 96 points.
Bansal said that the fintech revolution has eliminated the need for middlemen across sectors.
Now the Nifty up 50 points. It has come off from the highs.
Well, that was the day so far. Things are quiet on the index front as we wrap out today's trading session. Pretty directionless. You're watching Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Surbhi. Hi, Surbhi.
Hi, Reema. And one would have to say that it's turned out to be a little disappointing given the promising start that we had in the morning. The Nifty at one point was galloping a good 70, 80 points. But then it's kind of fizzled out again. The market's directionless, at least at the index level. And it's not just the Nifty you can blame. Even if you look at the Bank Nifty or the mid-cap index, it's just very, very quiet. And the action remains restricted to individual stock names.
Indeed. So today you've got the Nifty weekly options expiry. So let's see if the last 1 hour we have some action. And then post-market hours, the US, you'll get the non-farm payroll data. It typically comes out on Friday, but considering US markets are shut tomorrow on account of the Independence Day holiday, that data point is getting advanced. But as Surbhi was saying, it's all about individual mid-caps. While the small cap index, by the way, is up more than 0.5%. Look at DCM Shriram, 11% up. I think Motilal Oswal has hit a fresh 5 or 6 month high. Aster DM is gaining. A couple of these oil and gas names are higher. MRPL Oil India, case in point, rising nearly 3-4% on good volumes. And HDB Financial, we'll talk more about it, but that's clearly had a fantastic day too after a good day one. And sectorally in the large cap, if you're to pick one sector, I think it's auto. The Nifty Auto Index itself is up 1%, and its individual constituents, Hero MotoCorp, Maruti up more than 1%, and M&M and Tata Motors too, higher.
Yeah, absolutely. So, this is what it is. It's all about individual stock names, and that's what's driving the action. On the large cap screen, I mean, for now, it's there's a hint of maybe defensive buying that's quite evident. So look at some of the pharma and healthcare stocks. So Dr. Reddy's, Apollo, these are seeing some buying. Supply is also up about 0.8%. So pharma, healthcare holding out quite okay. And auto stocks, interesting. It's cumulative action, small increases, not a big move on any of them. But nonetheless, whether it's Hero MotoCorp or Mahindra & Mahindra, even Maruti Suzuki, we saw Maruti have a good session even yesterday. For that matter, even a Bajaj Auto. So some gains are coming in over there. And we must add that some of the big stocks, the heavy hitting boys, like Reliance and like Hindustan Lever, for what it's worth, they're all on the upside of the screen, including actually HDFC Bank. So if you look at the Nifty contribution chart, then a lot of these bigger boys, they're still on the green side of things. So it's not too bad. Though, as we speak, the sensex is just flashing a tinge of red. The Bank Nifty is flashing a tinge of red. So for sure, Reema, it promises to be a pretty exciting 60 minutes. I think it won't be as dull as what the day has been.
Okay, let's find out how you should position yourself then in the last 1 hour of trade. Mitesh is now with us with a few closing strategies. Mitesh, do you think things could turn around first in the last 1 hour, and what would the positioning be?
I think, pretty disappointing that we kind of bounced back from 25,400 and then, we didn't see any kind of follow through. So I think we are back to those 25,400. If in case we start breaking below that, there could be a chance that you might go to 25,200, but that should be it. And the market will again, go into some kind of consolidation. So nothing negative. Yeah, but I think, the fact that it's kind of come up from the day's high means that you need not be very aggressive on the long side.
Mitesh, what about individual stock names? What are you going with last hour?
So Bosch is something which has given a very strong pricing volume breakout by here with a stop at about 34, just below 34,000 for targets of 35,200. And the other one is Chambal Fertilizers. It's been consolidating on its 200 average value. The stock can now be bought with a stop at 552 for a target of around 580.
Okay, so looking at Bosch, Bosch indeed has moved up smartly, 5% or so higher. That's on the mid-cap side. On the large-cap screen, Mitesh, any takeaways? I mean, some of these auto stocks, like I was highlighting, even yesterday, they were up a little bit. But I don't know if there's any clear trade that you're seeing. Maybe an HDFC Bank, Reliance, Auto, any large-cap?
Reliance has already rallied a bit, and HDFC Bank has kind of started to get into contracting kind of mode after making a fresh high beyond 2000. Within the large cap space, my sense is that for the time being, just avoid it out. You'll find trading ideas somewhere in pharma space, couple of IT names, and a few other stocks. So and cement is something which is very clearly outperforming. So the broader large cap, I would just stay away from it.
Got that. Let's talk about the big drama which is unfolding now at the airport. One day after Dream folks accused two airport operators of pressuring banks to block or stop transaction payments made to the company, Adani Airport CEO has made a clarification about eliminating middlemen in the airport lounge business. Madiha now joins in with the entire story. Madiha.
So Adani Airport CEO Arun Bansal has spoken about the airport's lounge business in a LinkedIn post. He said that passengers across India can now access lounges directly through Adani Airport's platform in partnership with other lounge operators. He said this has been made possible by the innovation coming out of the group's in-house digital lab. Bansal said that the fintech revolution has eliminated the need for middlemen across sectors. In this case, he is referring to lounge access providers like Dream folks. He went on to say that in today's tech-led world, only companies willing to disrupt themselves will survive. The rest will disappear, is what he said. Remember, this comes a day after Dream folks told CNBC-TV18 that it is being pressured by two large airport operators to exit the lounge business. They claim that there's a coordinated campaign to damage their reputation and push them out of the market. Now, for context, Dream folks is a lounge access aggregator. It offers lounge access not just at airports, but also at railway stations, highways, and even visa centers. Now, just to add some context for our viewers, here's how the lounge ecosystem operates. The airport operator awards the lounge contract or runs it directly. The lounge operator manages day-to-day services. This could also be the airport operator itself. The access provider, like Dream folks, connects passengers to lounges via partnerships. Then payment gateways like Visa, MasterCard and RuPay enable the transactions. And finally, banks and credit card issuers tie up with access providers like Dream folks to offer free entry to customers. So when Arun Bansal talks about eliminating middlemen, this means doing away with lounge access providers. So in an airport where Adani is the airport operator, lounge operator, it will also be the lounge access provider. This is what we've understood from Arun Bansal's LinkedIn post.
Okay, all right, Madiha, got that. Thank you for the context. Indeed, this is snowballing into an ongoing dispute of sorts from the looks of it. And today, for the second day running, we have the Dream folk stock under pressure. Last I checked, it was still down about 5%. Let's pull up Dream folks. And obviously, it's been a huge wealth destructor as well this year. Pull up a one-year chart or even a year-to-date chart of Dream folks. It's been a huge underperformer. Down, I think, 40-odd% in 2025 and down even more if you're looking at the last 12 months. 45% this year. That is Dream folk. Let's quickly get in a comment from Deven Choksi, who's joining in. Deven, you were, of course, hearing the story play out. You've heard the explanation from the Adani side as well. What's your sense? I mean, if someone has been holding the stock and if they were patient, thinking, okay, I bought a good business, I like the company, let me, stay patient. If someone's not sold, I mean, what is it already too late? And on the flip side, would you at all look at venturing in now?
So good afternoon, Survi. I think while not completely sure about, I think what is the total dent in the revenue that this particular company would have in a course of time. But one thing which appears very clear to me is the disintermediation process. This disintermediation process is a profound one because I think as the use of, the fintech and the last mile connectivity by the aggregators like, I think, or the airport operators like Adani Airports, I think would really mean that I think companies like Dreamfox will have to reinvent their business model. Having said that, I think some of the smaller airports where I think the larger players' availability is not around, they can still continue to offer their services. But over a period of time, I think these particular services would remain under threat also on the margin front. Apart from, I think, the technology dent, I think that you are going to see in this kind of situation. So not completely sure whether the investors should be holding into this particular company or not, because immediate attention may not come on to the revenue loss beyond a point. But I think a long-term threat cannot be denied if the disintermediation process is a reality.
Okay, that's quite a lot of wealth destruction taking place in Dreamfox. By the way, markets, the Nifty is now on the verge of breaching the 25,400. So things are unraveling, down 50 points in the Nifty. Reliance Industries has turned. So Reliance Industries is down close to about 1/3 of a percentage point. But from the day's high, we've seen it slip. That's the 12-month chart. If you could pull up an intraday chart, there you have Reliance Industries. What a sharp fall.
Very sharp fall.
Very sharp fall seen in Reliance Industries. So that's contributing on the way down. Exerting pressure is also L&T. Some of the PSU banks like State Bank of India, ITC, and Bajaj Finance. That's down about 4% now from the start of the week. So while HDB Financial is gaining, Bajaj Finance is seeing some of its value getting eroded, and there, 25,400 gone.
Yeah, this is a rapid fall that's come in, and the day just got a whole lot more disappointing for the bulls, because it's not like there's a major global sudden risk-off or anything. Most of the markets are holding up. Europe is seeing plenty of sort of green on the screen. This is India-specific. Maybe it's expiry-specific. And along with Reliance, look at the fall in stocks like Bajaj Finance, L&T, all sharp drops coming in. So we'll have to watch out for, once again, the FII number. Remember, in the morning, Nigel was also telling us that the FII positioning on the short side has been increasing. And from the looks of it, I don't think those shorts are running for cover anytime soon. Suddenly, it's a 60-point drop on the index, and a very, very rapid one at that. We'll try and get Mitesh back as well in a bit to do a quick technical check. But yeah, it's across the board. SBI, L&T, Mahindra & Mahindra, pretty much across the board. Devin, I mean, on the market as a whole, we've had a great last 2 months. Markets, run up very well. But I guess the old argument always comes back that at these levels, these valuations, do you have enough triggers to go higher? I mean, what have you been telling clients? Stay away from large caps, look at mid caps, vice versa. What's the broader call for the next couple of months?
Well, I think the mid caps are purely fueled by the momentum. And I think the momentum is driven out of too much of money chasing smaller equities or smaller holdings. And that's where probably I think the valuations are becoming more crazy. In the large caps, I think the potential remains still very, very high, because I think on one side, we are talking about revival in the growth in the current financial year. On the other side, we are talking about, I think, the margin improvements for most of the businesses in the current financial year, largely because of the fact that I think compared to previous year, we are seeing the better impact of input cost in most of the businesses, including commodity businesses. Given that kind of a situation, our take is that I think some of the larger companies, the bigger companies, could possibly roll faster and possibly show better growth. For example, if today Bajaj Finance is 4 lakh crore plus kind of a AUM, HDB Financial is about 1,20,000 crore kind of an AUM, so 1/4 the size. Now, given the kind of growth rate that these kind of businesses are assuming of around 25% in the AUM, I think some of these companies or the businesses could possibly move faster. And that's where I think you will see the inclusion of these stocks into the portfolio of some of the investors, because the relative growth is going to be faster in some of these businesses. Similar situation we are seeing in the consumption story, largely in the discretionary and non-discretionary both. I think because of the disposable surplus availability in the hands of the consumer, also because of the lower cost of the fund, we are likely to see the consumption-related activity taking off in due course of time in this financial year. So we relatively remain bullish about the prospects, and at the same time, I think the larger companies could deliver bigger profits. That's a theory on which we are operating.
All right, let's get a handle then on the consumer names and the kind of updates that we're getting on Q1, the quarter gone by. Avenue Supermarts and V2 Retail. Manglam is here with the numbers.
Well, for Avenue Supermarts, it's a 16.2% revenue growth that the company has reported. It's slightly softer than what the company has been reporting on a historic basis in the first quarter of the last couple of years. The 2-3 year CAGR has been 17.2, 17.3% itself. And that's what analysts were pegging their estimates to be as well. So to that extent, mildly below street expectations. But if you look at the store additions over the last 1 year, that's been around 14.3%. This implies that there has been positive same-store sales growth. Morgan Stanley pegs that number to be around 3 to 4%, could be around 1 to 4% as well. So that's something we'll have to watch out for. The reason why the stocks recovered from the lows, is because 16.2% in this environment, not particularly bad. Product mix improvement is something that everyone is eyeing, along with their store opening plan, on which DMart has been fairly sanguine, saying that they look to increase the store addition or the pace of store expansion. And finally, in the consolidated numbers, we will also have DMart ready, so on which the scale-up of that will be something that the street will be eyeing. On V2 Retail, the revenue growth of 51% has been fairly impressive. But here as well, the stock came off highs because it's not led by same-store sales growth. Same-store sales growth actually is just around 5%. And the reason for V2's same-store sales growth being lower is similar to that of VMart, where Eid shifted into Q4 this time as against Q1 last time. And as a result of which, if you take that into account, then the same-store sales growth normalized has been 10%. So all these factors are in focus when the retail companies are, as far as the retail companies are concerned. We also have bazaar-style retail, which after the 37% revenue growth, reported 3% decline in same-store sales growth for the very same reason. And that stock too, fairly off the highs today.
Okay, all right, got it. Manglam, thanks very much for running us through the numbers. Market keeping a hawk eye on these updates and, of course, eventually on the Q1 commentary as well. Devin, just come in a little more in terms of more detail. You said that, of course, you're keeping a favorable stance on consumer. But then I guess the expectations are also elevated. The market is hungry for growth. And look at, for instance, DMart today. Though they've delivered about 16%, like Manglam was saying, the market still is not, in the mood for it. So within consumer, what are you most optimistic on?
Well, I think the important aspect would be the auto ancillary, and particularly within the auto segment. We would remain distinctly bullish about the prospects of commercial vehicles and the tractors. Given the kind of strength of rural economy today, and also due to the better start of the monsoon, we believe that I think this year is likely to be a good year for these two categories of auto. And that's where probably auto and auto ancillary businesses, I think within this bracket, discretionary consumption could possibly see relatively higher amount of growth in the current year. Fortunately, the auto stocks are also having the prospects of better profit margin in the current year because of the lower input cost, lower raw material cost. And at the same time, for the buyer, because of the cheaper availability of finance, I think is also making sense today. So I think it's in a sweet spot as I see it. But I think one will have to be relatively more selective about the respective companies that one adds into the portfolio. When the valuation upside is still available, I think those companies will be slightly better off compared to the overall basket.
The biases today at least shifted towards, say, a Hero MotoCorp or Maruti Suzuki in terms of gains, which could benefit if there is more money in the hands of consumer or the rural economy revives. Though in terms of pure numbers for the month of June, it was premiumization, Eicher Motors and M&M's Auto which stole the spotlight in the show. But let's get chatting about the Nykaa block deal. Manglam is now joining in with the details. Manglam.
Well, 2.1% equity was changed or exchanged hands in Nykaa in today's trading session. And since last evening, Vivek, our colleague, has been telling us that the likely seller are HP Singh Banga and family. They've sold about 2.1% equity. But that's one part of the story. The other part is I was just trying to look at the shareholding pattern of Nykaa. And ever so often, we do keep getting blocks in Nykaa itself. So HP Singh Banga, holds about 4.9% stake in the company as of March 2025. This obviously comes down by 2.1% if he is indeed the seller in today's trading session. He's been selling in the last couple of years or so. The other individual investors that I've been looking at, Sunil Kant Munjal is one. His stake come down from 2.5% in March 2024 to 1.4% over the last 12 months or so. In fact, the public shareholding of Nykaa, the number of shareholders itself, has come down from 5.85 lakh in June 2023 all the way down to 5.2 lakh the next quarter, thereafter 4.7 lakh in June 2024. And if you look at March 2025, the number is down to 4.72 lakh itself. So a large number of shareholders, individual shareholders, have come down, and that's reflective in the public shareholding of the company itself, which is halved from 26% in June 2023 to 13.8% in March 2025. Who's buying? Is it the FIIs? Turns out not, because even the FII shareholding of Nykaa has come down from 10.5% to close to 8.8% in the last 4 quarters or so. The increase in shareholding has come in from domestic institutional investors, which have increased their stake from 18% in June 2024 all the way up to 25% in March 2025. Who are these domestic institutional investors who've increased their stake in Nykaa? We have ICICI Pru, where the holding has gone up from 1.5% to 4.5% over the last 4 quarters. Nippon AMC too has increased its stake from 3% to 6%. HDFC Life, another life insurance company, which has increased its stake from 1% to about 1.3%. And we have Kotak MF as well, which has increased its stake. Remember, the stock in this year is up 24%, but prior to this year, between 2022 and 2024, was actually down 42%. And even if you adjust for the bonus and look at the issue price, the stock since IPO has returned just 8%. So are things turning around for Nykaa after domestic institutional investors are increasing their stake? The company has spoken about strong runway for the beauty market, also break even for fashion business this year, 30% CAGR for their own brands, and steady state margins of 10% for their fashion business. Let's see who wins the battle of shareholders in Nykaa from here on.
You know, I read in one of the articles, Mangalam, that, the gentleman who's selling today, the Banga family, they were early investors and they had bought into Nykaa when the market value or the market cap was $25 million. And now it would be what? $6-7 billion.
Oh.
So, early investors, and he's reaped the benefit of that and now partially exiting. Thank you very much for putting the spotlight on how the shareholding of Nykaa has evolved over the last couple of years. Retailers are exiting and domestic mutual funds have been increasing their holding. Deven, you want to quickly comment on Nykaa? Things have improved from a shareholder point of view in terms of price gains this year.
Yeah, I think they're promising to do the bottom line profit performance in the current financial year. So hopefully, I think if the last quarter result around, I think that promise will get materialized at some point of time. In my viewpoint, I think everything seems to be in price. Maybe the market may remain a little bit more excited about quarter-over-quarter improved performance in this company's case. But more importantly, everything appears to be in price. Unless we see some scale-up, which is a significant scale-up, I think this kind of business would remain relatively expensive proposition for investors.
Okay. That is Nykaa. I think we just have time for one last question with Deven. Deven, I was actually looking at a report that we get from Knight Frank. I mean, they do this half-yearly real estate market update. And the one page on that presentation that really caught my eye was the pager on residential trends and how residential trends overall, the last couple of months at least, across markets, there is a gradual plateau. They're not falling, but there's some plateauing happening. What would you say would be the takeaways for listed players? I mean, it could actually be irrelevant because one could argue that listed players are actually seeing the benefits of market share gains. More people are looking for branded houses and quality developers. So I don't know if there's any reason to be concerned from a listed real estate stock point of view. Your thoughts?
So, Surbi, I think between the two categories, the mass market community living and the luxurious housing, I think the mass market community living is having relatively surplus stocks in some pockets. I think one can't be saying that in every pocket it would be, but in some pockets, they may have, slightly surplus stocks, including in a city like Mumbai. We are seeing in some of the developers' case, some surplus stocks available, which they are trying to push hard to sell. Whereas on the other side, again, taking example of city like Mumbai, the luxurious housing business, is possibly moving at a reasonably good speed and at the same time, fetching better realization to the developer. In fact, from that study itself, one finds that in next 15-20 years from now, there would be a case of around 30,000 redevelopments in the city of Mumbai itself, Should that be the situation, and I think those redevelopments move in the direction of luxurious housing, quite possible that the companies focusing on luxurious housing would probably have relatively better time to talk about, because they're addressing the few people and at the same time, I think, getting the better realization out of those properties. So we remain selectively bullish about the prospects going forward. However, in the current listed market, most of the companies are completely pricing in the scenarios for FY27. So immediate upside of the headroom is seen limited, maybe some price correction, and that could be a better opportunity going forward.
Okay. All right, Devin, we'll leave it on that note for this afternoon. Thank you so much for joining in. Appreciate your time. Let's take a break. And as we do take this break, here's a quick reminder. Please do tune in to the all-new CNBC-TV18 Prime. We bring you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Okay, welcome back. We've had a bit of a wobbly afternoon in the last half an hour or so. The market fell as much as 55 odd points on the Nifty. Then there's been some recovery. but it's still lower. Even the bank Nifty is down about 0.3%. So little, that's been how it is. Choppy today, especially in the second half. Well, how are we poised as we look at the second half of the year? Vikas Khemani of Carnelian Advisors is with us now. Vikas, thank you so much for being with us. So that's really the question, right? And I think the market is very fairly divided between the bull and the bear camp. The bears say valuations are high, earnings will be pedestrian, 10-11%. The bulls say at least we'll get 12% growth, a revival in earnings, and a consumption boost, an RBI boost. So the market's looking good. What do you think?
I think if you can make out from our past conversations, I'm definitely in the second camp where I think definitely earnings is on a very big revival. Post RBI action of aggressive interest rate cut and infusion of liquidity in the system, there's no doubt in my mind that corporate earnings would be better. Of course, there could be one quarter and there that nobody can time out. One important factor to watch out is, of course, the BTA with US, which is expected to happen on 9th July, and I think everything goes fine. Then I guess there are not much risk. So generally speaking, I'm quite optimist, and I don't believe that India is very expensive. In fact, I feel that India will get further re-rated, in times to come. There's no market around the globe of the kind of size, growth, sustainable growth, quality of the growth. So everything is, I think, in place. In fact, most global investors are underweight on India. Indian investors are underweight on equities. So I think, in my opinion, those who are calling markets expensive will keep probably either missing out or keep sort of. There could be tactical correction here and there, but I'm sure those calling market expensive are not expecting it to come to 15-16 times price to earning ratio. So if it is a little bit of 5-10% correction here, that is par for the course. That happens all the time in the market. I'm not talking about that. But other than that, structurally, I don't think India is going to get de-rated further. In fact, I make a very big case for India getting re-rated further in next 3 to 5 years. You said Indian investors are underweight India? Yes, of course, because Indian household exposure to equities is still around 5%. If you look at, China is 15, US is, 30-35%. So it is a very small kind of, 10 years ago, Indians were only 1%. So it's only going to grow from here. Obviously, from 1 to 5 also looks a lot because we are not used to getting this kind of flows. And hence, that's the reason I think there's a lot of narrative which gets created that Indian SIP will stop, Indian flows will stop. But I don't think that's happening anytime in a hurry. In fact, that's only going to get more. And once you have that perspective, I think in equities are only going to get bigger and better in everybody's portfolio. Well, indeed, that's a structural tailwind and a long-term one at that. Because you're the master of finding, individual stock ideas. Tell us a little bit more, in terms of interesting ideas or trends that you've spotted, which could be big plays. When kind of find trends are kind of pretty similar. You don't really find trends every now and then. We've spoken about CDMO, CRO being a big space, manufacturing in general being a very big space over the next 10 years, rising per capita income leading to the premium consumption is again a very, very big space which one can look at. And again, I'm not talking about all ideas in general, but you will have to identify specific ideas in those sectors. BFSI itself is a very big opportunity. According to me, if you ask me, the sheer quantum of the wealth, the absolute amount of wealth which will be created it will be in the banking BFSI sector, and more services sectors are coming into the space. So I see a situation where across the board, India will sort of do very well, specifically in BFSI, consumption, manufacturing. These kind of some place would be probably a little bit more niche. Absolutely. Take your point. We have discussed, of course, agrochemical stocks also. It's something that you like. You're expecting, turnaround to play out. You won't name stocks, Vikas, but give us, a little more of a sense, a slightly deeper sense. For instance, you said premium consumption, but a lot of these stocks have also run up, whether it's hotel stocks, whether it is something like, real estate. Which way would you play premium consumption now? Through which micro segment? You have to, and you're right in that sense. The interesting thing is that wherever, so see, in consumption space, what's happening is consumption patterns are changing. What consumer consuming earlier may not be consuming. So new age consumer are consuming different, and they are kind of basically they're consuming more, new and better, and that's how it happens. But those shifts are there. And one thing is very clear that premiumization is happening in every category. So those benefits, so wherever companies are aligned in this, you have to look at this. Now, hotels, of course, is a very big segment. The entire hotel capacity of India is less than Dubai. So it's a huge scope. But the point is that, it has its own, sort of valuation. I mean, its own, like you have to put up capex, which takes time. And by the time, so a lot of companies are going into a capex phase. And to that extent, I think, and valuations are like very demanding. So you got to be careful. Very often, just because something is looking promising does not mean that it will, make money or you have a money making opportunity based on the risk reward. Because as an investor, we have to see risk reward of investing is there or not. Very often fads do come about and, you get carried away by those fads and say that, so don't invest just based on like macro looks good, but you have to find micro risk reward also in the favor to make money.
In the past, you've spoken about infrastructure plays, I think, in railway and airports. So airports, of course, there are limited ways to play it. You only have, say, an Interglobe Aviation. But on railways, can you provide some more color on how you're playing it?
I think so. We don't have. I think in railway there's a lot of, in my opinion, fad and valuations are kind of on the other side. And so more than that, I think I'll probably comment on your infrastructure comment or question that I think there's an interesting play where we can find deep value and or a very interesting value is in the EPC players, the pure play EPC players where margin profile is very good and the working capital cycle has got compressed because today execution has become very, very important, whether it is public contract or private contract. If I am doing a construction of a building or construction of road or construction of metro, the timeliness of thing has become very important. Hence, the working capital cycle has become important. Order book of all the companies are very large. Now, a repaired or better business model and available at 10, 12, 15 time price to earning versus all other players which we talked about, which are like so structurally investment cycle is on uptick. The executor or doers of those investment cycle are right now available at a reasonably good valuation. That's a one sub segment. I do believe that the risk reward is hugely in favor.
Okay, that's interesting. Yeah, EPC players, and we haven't seen the market to talk about them, and they've almost become forgotten. Pure EPC contractors. Got that point?
And here, one thing which, in my opinion, markets have missed is the repair on the working capital cycle. Historically, I think this sector has been struggling with the working capital because payments get delayed. But today, be it a private or public sector, everybody wants to get execution done faster. And because of that, the payments don't get delayed, generally speaking. I'm not talking about for everybody, but generally speaking. Hence, your working capital cycle is better. Hence, your cash flow generation also has become better.
Okay, all right. That's a very interesting perspective. Because before we let you go in manufacturing, and we always discuss this with you, it's a very wide, array. Everything can be clubbed under manufacturing. So you need to know what to pick and where to go. So give us some more nuggets. I mean, perhaps it's CDMO, that's what you're looking at. But within manufacturing, for instance, would you look at power, something else, auto ancillaries?
I tell you, I think broadly, you rightly said, it's broadly spread between auto components, chemicals, textiles, garments, power, capital goods, defense, electronics, multiple, right? But I think right now we find a lot of risk reward, especially in the chemicals where most people are negative around it. Structurally, chemical is a very good play and most people have kind of, don't own it and some companies have struggled. But we think the inventory cycles have cleared, bad cycle is behind. In risk reward is falling into place. That looks reasonably good, but differentiate between commodity and specialty chemical. That's where most of the fault, the mistakes gets made. And secondly, I think we think that even some of the auto component companies are also, again, I'm making a general statement, but you've got to look at company specific. They are also interesting. Risk reward is falling into place for many companies. These are two sub-segments. We have recently found some values and some ideas.
Okay, all right. Good clues there, I think, for our viewers to then go ahead and do their own homework. Thank you very much for joining in. Nice conversation as always. You have a good rest of the day. That's a view from Carnelian Asset Management, Vikas Khemani, with his thoughts on the market. Let's take a quick break on that note. We'll come back on the other side and we'll, of course, have final trading ideas coming up with Mitesh Thakkar, and then we'll focus on some more stocks. Welcome back. Let's go back to Mitesh for some final advice and trading calls. Market got really wobbly. Let's put up the Nifty again. Last half hour, we've seen some volatility come back in, but it's still within perhaps a trading range. Mitesh, yeah, there we go. Actually, no, we're back again down 50 points. We had tried to recover back up to the flat line, but again down 50. Mitesh, what do you make of the weakness?
I'm actually not, very happy about the way the markets have fallen, because 12.4 was a good support. We got a bounce back, but then the follow through went missing, which means that there's a good chance that we might actually test 25,200, and that should be an important support area coming in. So if the market has to consolidate, possibly 25,200, 25,650, 700 probably could be the range. And on the stock side, I have one buy and one sell. BTST on 361 wealth management. I think that's BTST with a stop at 1208 for targets of 1245. While DLF and real estate stocks have slightly turned weak. So DLF is STBT. People stop at about 836 for targets of 815.
Okay. Got that, Mitesh. Thanks very much for the calls. You have a good rest of the evening. We will see you again tomorrow. Let's move on now and talk about some of the updates that we're getting from the financial services space. Now, we all know about the new listing, HDB Financial Services. It was a good listing. Yesterday itself, the stock was up 13%. It's actually put on some more gains today as well. Gaurav is bringing us some more analysis on the stock, how it fares compared to the peers and how the valuations look right now. Gaurav, take it away.
Well, yes, when we talk about HDB Financial, we have already seen good set of numbers from the company in terms of returns for investors, because the listing gain itself was at 13%. And let's not forget that even if we consider the listing gain, even if we consider today's gains as well, the valuations are still not as high as how we were expecting it to be, because the valuation is still trading at 3.5 times price to book value. So let's understand the business first. What are the good points and bad points? When we talk about good points, HDB Financial is one of the companies who reported good set of numbers in terms of gross NPAs if we compare it with the peers for the last few years. In fact, in FY25, gross NPAs were actually lower than its peers. Other than that, when we talk about some other points, we also have portfolio mix, which is actually very diversified, and that is the reason which gives an upper edge to HDB Financial over the other peers, because when we look at secured portfolio, it is around 73% of its current portfolio. When we look at PAT growth, there also we have seen a good set of number. 29% CAGR is what we have seen for the last 4 years. But on the other hand, there are some pitfalls where market is a little conscious. First is the AUM growth. For the last 4 years, AUM growth has been at a CAGR of around 20%, which is a little lower if we compare it with its peers. ROA is also at 2.2%, which is again a little lower, and the reason being that credit cost was actually high in FY25. Now, from what we have picked from the management commentary, credit cost is likely to stay a little high in the tune of 2%, and that is the reason there are some concerns around growth in ROA. But even if we consider all these factors, the valuations still seem fine, because at 3.5, it is still trading below what the street and the other players, if we compare it with its peers, is trading. Because when we look at Chola Finance, it is trading currently at around 4.5 to 5%, 5 times price to book. Bajaj Finance is also trading at somewhere around 5 times price to book. In fact, we also did a little bit of valuation check. If we take the stock even higher at the range of around 1,000 rupees, then also there will be a valuation comfort, because the stock will still trade at 4 times price to book. So definitely at the current price, it seems that the stock is finding some kind of comfort in valuation as well as growth. But it will be definitely a key thing to watch out for, an interesting play as how HDB Financial investors gain from here on.
Okay, all right. So right now, valuation comfort, which is not what you can say about a large part of the market. Gaurav, thank you very much for the latest there on HDB Financial Services. It's holding up well with a 22 rupee gain. Now, staying with the updates from the BFSI space, this is a CNBC-TV18 exclusive. Karnataka Bank saw leadership shake-up after the MD and CEO, Sri Krishna Harihara Sarma, resigned, citing personal reasons. Earlier, we caught up with Mr. P. Pradeep Kumar, the chairman of the bank, and spoke about the interim leadership arrangement and the impact of these changes on the business.
We have recommended an interim MD to the Reserve Bank of India. We are awaiting Reserve Bank of India's approval for the new interim MD. And we trust that the Reserve Bank's approval for the interim MD will be in place before the 15th July, when Mr. Sri Krishnan will be resigning. I can't say anything at that time of who is the new interim MD. I mean, these are all, unless the regulator approves and I tell the stock exchange, I can't tell anybody else. So the bank's liquidity position is very comfortable. And if you had observed our capital adequacy ratio is at 19.85, I think, which is one of the highest in the industry. So we have enough capital for growth for the 3-4 years, and we have sufficient liquidity. I don't think neither liquidity or capital or growth is going to be affected.
Well, that's the word coming in from Karnataka Bank. Let's invite Ambrish Baliga on the last leg of this show. Ambrish, thank you very much for joining in. Things have been very, very quiet over the last couple of days. Perhaps just waiting for the India-US trade deal to get ironed out, negotiated. And we have it in full and final terms and what the contours will look like. And plus the earnings season is awaited. What have you been doing with respect to your portfolio?
In fact, at this point of time, I've just been holding on with a clear view that in case we had seen markets going beyond 26,000 to possibly a new high, which was the view about 4 or 5 days back, at those levels, surely I have booked some profits. But otherwise, I'm just holding on for the time being. I really don't see the markets going down too much from here. I think 25,000, 25,200, I think is a very good support level. But at the same time, I'm also holding about 10% in cash, because in case we see a sudden dip for whatever reason, it could be because of the trade agreement issue or whatever it is. If we get an opportunity, I'll surely deploy that 10%.
Okay. All right. Speaking of deployment, Amrish, hi, afternoon. Let's talk about your stock pick for today. Which one is it?
The stock pick is Uno Minda, which is a global tier 1 manufacturer and supplier of automotive components and systems. I mean, they have a huge product portfolio, about 25 categories, but mainly into automotive switches, lighting, castings, seating and acoustic. And the new segment, they have EV-specific products, sensors, controllers, ADAS, blow molding products, and catering mainly to two-wheelers and passenger car segment. But now they are also focusing on CVs, three-wheelers and off-road vehicle segment, and mainly supplying to OEMs. But they also have a small replacement market, and 90% of the revenue comes from India. They have about 74 manufacturing facilities, about 37 R&D centers. And for the next 3 years, the revenue CAGR expected is about 15%. EBITDA CAGR is expected to be about 16%. I'm expecting an EPS for FY27 of about 23 rupees. With that, my target price becomes about 1265.
Okay. What about Bosch? That also could be a beneficiary of this anti-braking system if it's implemented for two-wheelers. Is that not correct? Have you done any analysis on it?
No, I have not looked at it in depth, so a bit difficult for me to really comment on this.
Fair enough. Lots of individual stocks are moving in the mid and small cap universe. DCM Shriram is now up nearly 15%. I think the stock has also hit a fresh high, moving above that, 14,000. DCM Shriram, 1400 mark now on DCM Shriram. You've got a Aster DM with a 9% up move, Motilal Oswal, Trans Rail Lighting, a Saxoft 12% up, Lloyds. Any of these stocks, on your radar, have you looked at? Because these are big moves in one day.
Yeah, in fact, DCM Shriram is one of those which we've been tracking for a while, and I think the move has just about started. And in fact, here we believe we could see levels of about 1580, 1640 levels, possibly in the next 3 to 4 months.
Okay, that's DCM Shriram. Could move higher. Amrish, do stay on. We just wanted to get our viewers to listen in to the views that we got from Vineet Sambre from DSP Mutual Fund and Hartmut SL from UBS Global Wealth Management. As we slip into a break, listen into these excerpts.
Long-term investors, I think the second view is more palatable. But let me say that I think at the moment, both the views are somewhere, I would say, balanced. And I think it is a time frame with which each of them are sort of looking at the situation at the moment. And clearly, as we have recovered from the market lows, which we had seen in the month of March to now, valuations have seen, it seems to be a bit punchy across the board, not just few sectors, but across the board. I would say that the macro factors are now more conducive for growth versus last year. This quarter, next quarter, we still have a slightly lower growth. So from that perspective, I would say that the growth outlook should start improving maybe towards the second half, and that's where one should start looking at some directions for the market. I think the portfolios really doesn't change as much really from the very short-term perspective. But broadly, what we are trying to align our portfolio towards is these macro factors which are going to mean that the balance of trade could shift to consumers as a category towards the maybe end of this year. So maybe it would be a good way to create a basket of categories, a basket of companies within subcategories, maybe a white good as a category, apparels, innerwear, QSR, some of these, and take a broader call that if we broadly are with companies which are sort of leading companies within those spaces and likely to be beneficiary of the macro trends, I think we need to take them as a basket approach, and which is what we have also done as a part of our portfolios.
In our forecast, we have close to 7% probably earnings growth, which is fairly low. So if you're a company, an average company that says, okay, I compare myself with 7% with only, so to speak, 7% before, that's much easier to beat than if I compare myself with a 25% growth base, right? So that is easier, but there's also many sector-specific reasons. Certainly on the financial side, although that's probably a bit more fiscal year 27 focused, but then it's really when it takes off. So as an investor, only sort of 9 months away, but you want to start positioning for that. And then also, what comes to my mind is also a sector we like a lot is the consumer side. So all of these things lead us to double-digit earnings growth, we think, for 2 years in a row after we had sort of a mid-single digit. And then why wouldn't I invest in this market? We have an estimate of upside for the Nifty of about, give and take, 11%, maybe 12, somewhere thereabout. So we could talk about 27,500, somewhere there in that area for over a 12-month space. So I find it difficult to suggest to anybody not to go into it at these current levels.
We've got just about 5.5 minutes to go. And the market seems to be still dealing with this negative bias, 50-odd points lower on the Nifty as we speak. A couple of stocks actually down quite a bit. Interglobe Aviation is cooling off. It's down about 3.5%. There's a Nykaa, which we've discussed. Names like ICICI Pru are down. The life insurers on the Nifty anyway are lower, but even something on the general insurance side is on the downside. Let's revisit the move on Dreamfolks. Amrish, we were discussing this even before you joined us, right? Because the stock has destroyed so much of wealth already. What would the advice be to existing shareholders?
No, in fact, we were discussing this last week. I think that's the time the management had stuck their neck out and denied the rumors. Whatever happened is a part of the business. Whether it's a pressure tactic or a direct threat, This happens in a business, and especially when you're a tiny player on one side and you have a mammoth on the other side. But what I'm concerned about is the comments last week by the management that the contracts are in force and there's no issue. I mean, especially when there are strong rumors of ICICI and Axis moving out. And now within a week, you report that these banks have moved out. I mean, you may have been right in letter since the contracts were expiring on June 30th, but not really in spirit. I think that is what is bothering me because it should have been addressed. I mean, one need not have talked up the stock for a few days. I think the credibility is at stake. I mean, airport lounges is still a huge opportunity. I mean, there are many tier 2 airports which lack this facility, and that's growing. I mean, you have the other segments like lifestyle, wellness, golf. I think those are the other areas of opportunity for them. I think, I mean, the most important addressable issue out here would have been I mean, what's your plan B? Your plan A seems to have failed because of this. What is your plan B? I think this should have been addressed because 35 to 40% of the properties are at stake. So this is the issue which I saw, I mean, from today's announcement or the comments which came. So, at this point of time, I'll not really, go out and buy. I mean, although it's fallen a lot. I mean, unless I know as to where the company is going, I'll surely not look to venture out to buy.
And if someone already has a holding in Dream Folks, what would you advise?
I would say if you can afford to book a loss, book a loss.
Okay, got that. Blue Star, Amrish, we chatted with the management earlier and they did indicate that, Q1 was weak. In fact, the industry saw a degrowth of about 20-25%. But for the full year, they're saying that things will still pick up. I think they're guiding for a 10 to 15% growth for FY26. And even this commercial ACs, which are used in data centers, that's picking up. As a growth avenue. The stock today is higher by nearly 5%. What would your thoughts be on Blue Star?
I think that's a view coming out for the industry overall, that the last couple of months were not too great, but going ahead, clearly, they are looking at business picking up. And because of which you have seen this also in Voltas. Voltas also has been like one of the performers today, despite the way the markets are. So I think even at these levels, it could be bought at, I would say, both Blue Star as well as Voltas, because possibly over the next 1 or 2 quarters, we should see performance improving and the demand growth happening. So I think we should see much better levels from here.
Okay. I think we're running into market close now. So Amrish, just give us a second. We'll quickly recap what has been a disappointing day for the bulls, you'd have to say. I mean, if you look at it optically, it's not too bad. I mean, it's about a 0.2% cut, which is hardly anything. But why we're calling it disappointing is that the market has stalled. It has stalled every single day this week, 4 trading sessions in a row now, unable to decisively move higher. Perhaps some time correction going on, some caution, which is par for the course, 25,400 on the board. So let's talk about the large cap movers and shakers and what we have today. On the lower side, like I said, some of the insurance stocks are weak. SBI Life, for instance, down almost 3%. Even the other financial stocks, look at Kotak Mahindra Bank or a Bajaj Finserv or a Bajaj Finance. Largely speaking, financials have been weak, including banks and non-banks and insurers. SBI, another name on the weak list, is HDFC Life, also on the lower side. So that's one pocket of weakness. Adani Ports and Enterprises, 2 more stocks on the weak list. JSW Steel undoing some of the gains from yesterday. Remember, yesterday ferrous stocks had a good run. Today was not a follow-up day at all. Titan was also on the lower side today. So that's the red side of the screen. The flip side, there is some sense of safety buying perhaps in the market, quite evident. Apollo Hospitals, Dr. Reddy's, these are stocks on the upside. Cipla also 0.7% higher. Some buying on names like Infosys as well. Hero Moto and Maruti managed to stand tall, including an M&M actually. So some auto stocks managed to get a little bit of a gain, not too much, but some that stood out. Relatively speaking, Rima, the mid-cap index has done better. I mean, at least it's had a flat close, not down too much.
Individual stocks, though, were weak in trade. Nykaa on the back of that big block deal of more than 2%. Stock ending lower 4.5%. PNB. The Q1 update showed that the advances growth in Q1 was about 9.5%, tracking lower than the company's full-year guidance of 11 to 12%. So the street was a tad bit disappointed. Avenue Supermart slipped. Again, the revenue growth of 16%, lower than the revenue growth seen in the prior 2 quarters. Bharat Forge, where the North America, Class 8 trucks were a bit subdued, under pressure. And then you had cuts in Vedanta, Sigachi continues to lose ground, NBCC, Sagility, weakened trade. On the way up, DCM Shriram, 19% up by the close of trade. Blue Star had handsome gains going for itself, and HDB Financial Services now at 867 versus the issue price of 740. Lots of action in individual stock, and that brings us to a close in this edition of Closing Bell. Thank you very much for watching. Don't go anywhere. Markets Forward is up next.